I know you're fairly bullish on equities. You're overweight the U.S. and China. Did the U.S. jobs report on Friday, more than 900,000 jobs created, did it increase your bullishness?
I would say it's a positive catalyst, of course. If you've been bullish, March was a pretty tough month, but I think now that we're heading into second quarter earnings season, also of course we'll get the second quarter economic releases from particularly from China. I think we're heading for a very positive start to the second quarter. So I wouldn't say it's increased our bullishness, but it's confirmed the case, which was we had to hold on during a kind of tough March.
So if you're going to stay equities and in equities and try to add to your position, what would you go into? I know you like tech, but a lot of people are cautious either because it's been purchased so much, it's gone up so much, or particularly if you look at China because of this concern about the government, tamping down on tech companies more.
Yeah, well, certainly in tech, in particular, need to be selective. I mean, we like some sectors within tech. We like global semiconductors, so you'll start to see some preliminary numbers for the first quarter come out of the two big Asia companies, Samsung and TSMC, later this week. We also like kind of the merger of tech and healthcare, which is now called healthcare IT, where you've got a large kind of inefficient sector in healthcare. Exploring ways to take out costs and lower costs through application of technology. So we definitely think you need to be a little bit selective within tech. If we talk specifically about China, it's not for us. It's a pretty simple trade, which is they were first in and they will be first out of COVID-19. So the first quarter year-on-year comps are going to be the worst in terms of last year's performance. So you're going to see first quarter GDP from China up, in significant double digits, and that should pull along some of the economic numbers. Of course, one of the risks out there is that the central government is, I wouldn't say trying to clamp down, but trying to put a bit more regulation around some of the large tech platform players, which I think may impact their investment opportunities into other sectors. But I don't think they're trying to take anybody out of business at the moment.
Kieran, I'm reading through your notes, and you seem quite sanguine when it comes to expected inflation upside, right? I want to throw up this chart that I think is really interesting, taking into account looking at output gaps and just the difference between inflation surprises or reflation surprises and sustained inflation. The top panel there is the IMF projected output gaps for advanced economies. On the bottom is Citi's Global Economic Surprise Index. You can see with that comparison, there's a fair ways to go when it comes to sustained inflation indicators. To that end, is the market overdoing it on these expectations, and what opportunities do you see?
We would say that the market is a little bit too focused on what's likely to be transitory inflation scare, perhaps, over the summer. And again, it's partly to do with base effect from last year. And against that, the Fed is going to have to, be pretty active, I think, around language that they're willing to look past transitory inflation, and in fact, they're willing to look past longer-term inflation above 2%, as long as it's not too far ahead, and until they start to look at rising rates. So I think we're definitely heading into an inflation scare situation over the summer, but our expectation is it's going to be transitory inflation, and the Fed is going to kind of pull the line with rates, at least USTR, where it is now. So, and partly reflecting that fear is the rising 10. So we could see U.S. Treasury, possibly push towards 2% over the summer, which of course we're now starting from a 1.7 rather than starting at below 1, which was the kind of tantrum we saw during the first quarter of this year.
Kieran, in terms of your positivity on Chinese stocks, obviously they lagged regional developing, emerging market peers in the last quarter. There's indications that they could lag again for another quarter. Are these concerns over shrinking liquidity something that bothers you? What are you opportunistic about in that space?
So, I mean, we are opportunistic globally around reopening and recovery, and on that theme, China is going to lead and probably provide the template for what's likely to be subsequent quarters out of the the U.S., other parts of Asia, much later in Europe. So that's our basis for our positive view on China. I think if you look at the first quarter was a bit of a weak quarter for equities, not as strong as the last few quarters, and for China in particular. But you also have to look at where we came from. So China had a pretty good fourth quarter, and we think we're set with the results and with the economic backdrop and the reopening and recovery trade to see a better second quarter, certainly from China, and particularly domestic China.
Kieran, are you at all concerned about any kind of real financial stresses in the emerging markets? This is going to be a big theme at the IMF World Bank meetings this week that could be exacerbated by recovery in nations like the U.S. and China, so that there's pressure on their central banks to raise rates, or there's capital outflows. Even if you're not going to invest in those countries, if that's the kind of thing that could cause a little bit of rough water for investors this year.
Yeah, well, I mean, I heard earlier you're reporting that the IMF is saying there's going to be, I guess, a divide between reopening and recovery in the U.S. and China, and that's going to leave other, particularly EM markets, behind. Well, of course there is, and it's partly to do with the, in the case of China, the quick reaction to COVID-19 and closing things down, and in the case of the U.S., the ultimately pretty quick rollout of the vaccine, which I think is probably contributing to, what we're seeing right now in terms of, let's say, the big job numbers on Friday. So, absolutely, and there's going to be a divide between the U.S. and China, and it's part of the reason why we, within the positive view on global equities, we want to focus on U.S. and China. Maybe down the line, there's room for, as other markets, particularly other EM markets, get serious about COVID and reacting to it, and vaccination and vaccines are available, et cetera. That might be a trade for later this year. But at the moment, we definitely feel like it's U.S. And China, and even U.K. Is doing a pretty good job, and we probably see some positive momentum there as well.